Today, we're diving deep into ETFs, exchange-traded funds, and breaking down 15 essential things every beginner should know. If you're new to investing, ETFs can be a great way to build wealth without a ton of risk or complexity. In this video, I'll explain what ETFs are, why they're so popular, and the different ways you can use them in your portfolio. Let's get started. This is Wealth Velocity. Here you create, protect, and grow your wealth fast. So what exactly is an ETF? ETF stands for Exchange Traded Fund. Think of it as a basket that holds a collection of different investments such as stocks, bonds, or commodities. When you buy a share of an ETF, you're buying a small piece of all the assets within that basket. ETFs are traded on stock exchanges, which means you can buy and sell them just like individual stocks. ETFs offer a way to invest in multiple assets without needing to buy each one individually. For example, if you want exposure to the technology sector, you could buy a tech ETF rather than researching and buying individual tech stocks. This makes it easier and faster to diversify your portfolio, spreading out your risk. ETFs and mutual funds are both popular investment funds, but they operate differently. One big difference is how they're traded. Mutual funds are priced once per day after the market closes, which means you don't know the exact price you'll pay when you place an order. ETFs, on the other hand, are traded on the exchange throughout the day at market prices, just like stocks. This allows for greater flexibility. With ETFs, you can react quickly to market conditions since you're able to buy and sell during trading hours. This intraday trading feature gives you more control over the timing and price of your investments, which can be especially useful during market volatility. There are several types of ETFs, each with a different focus. Here's a quick breakdown. Stock ETFs hold a mix of stocks and often track an index like the S&P 500. Bond ETFs invest in bonds, which can provide income and stability. Sector ETFs focus on specific industries like technology or healthcare. Commodity ETFs track commodities like gold or oil. International ETFs give you exposure to companies and assets outside of your home country. Different types of ETFs can help you achieve specific investment goals. If you're looking for growth, a stock ETF might be the way to go. If you want stability, a bond ETF could be a better fit. Understanding these types allows you to tailor your portfolio to fit your financial objectives. One of the most appealing aspects of ETFs is diversification. By investing in an ETF, you're spreading your money across a range of assets, which reduces the risk of any one investment hurting your overall portfolio. For instance, an S&P 500 ETF includes 500 different companies, so even if a few stocks go down, others might go up, balancing the impact. Diversification helps to smooth out returns and reduce volatility. For beginners, it's a smart way to invest without putting all your eggs in one basket. With a diversified ETF, you're less vulnerable to individual stock swings, which makes your investment journey less stressful. ETFs are known for their low costs, especially compared to mutual funds. Most ETFs are passively managed, meaning they simply track an index without the need for active management. This cuts down on fees since you're not paying for a fund manager to pick individual stocks. Lower fees mean more of your money stays invested. Over the long term, high fees can take a huge bite out of your returns. For example, an ETF with an expense ratio of 0.1% costs $1 per $1,000 invested per year, while a mutual fund with a 1% fee costs $10 per $1,000. That difference adds up significantly over time. ETFs are generally more tax efficient than mutual funds because of the way they're structured. With a mutual fund, capital gains taxes can be triggered when other investors buy or sell shares, even if you haven't made any trades yourself. ETFs, however, don't have this issue since shares are traded between investors on the exchange. Tax efficiency can make a big difference, especially for long-term investors. By reducing the number of taxable events, ETFs allow you to keep more of your returns. This makes them a great choice for taxable accounts, where minimizing capital gains taxes is key. Some ETFs pay dividends to investors. These are typically called dividend ETFs and include shares of companies that pay regular dividends. Dividend ETFs are popular among those seeking a steady income in addition to growth, as they distribute dividends from the underlying stocks to shareholders. Dividend ETFs can be a great option for investors looking for passive income, especially in retirement. You can choose to reinvest the dividends, which can compound your returns over time, or take them as cash payouts. How to buy ETFs. Buying an ETF is easy and works just like buying a stock. First, open a brokerage account if you don't already have one. Then, find the ETF you're interested in by its ticker symbol, enter the number of shares you want, and place your order. Most brokerages allow you to set order types like market or limit orders to control the price. The accessibility of ETFs is one of their biggest perks. You don't need a large sum to get started, and many brokers even offer fractional shares, allowing you to invest smaller amounts. This flexibility is ideal for beginners who want to dip their toes into the stock market. The importance of expense ratios. An expense ratio is the annual fee you pay as a shareholder to cover the fund's operating costs. For ETFs, expense ratios are typically low, but it's essential to compare them. For example, an ETF with an expense ratio of 0.03% is cheaper than one with 0.5%, which can add up over time. Every dollar you pay in fees is a dollar that isn't growing in your account. Even a 0.1% difference in expense ratios can significantly impact your returns over several decades. Always look for ETFs with low expense ratios to maximize your investment growth. ETFs and market volatility. ETFs can experience price swings, especially those that track volatile sectors or markets. However, diversified ETFs, like those tracking the S&P 500, tend to be more stable compared to individual stocks. Sector-specific or leveraged ETFs may show more volatility. It's essential to understand that ETFs aren't risk-free. Although they can offer more stability than individual stocks, some ETFs can be volatile, especially during economic downturns. It's wise to assess your risk tolerance before investing in ETFs with high volatility. Growth versus value ETFs. Growth ETFs focus on companies expected to grow faster than the market, often reinvesting profits to fuel expansion. Value ETFs, on the other hand, invest in established companies considered undervalued, meaning they trade at a lower price relative to their earnings or assets. Choosing between growth and value ETFs depends on your financial goals. Growth ETFs may offer higher potential returns, but with more risk. Value ETFs might be less volatile, making them appealing for more conservative investors or those seeking stable income. International ETFs for global exposure. International ETFs provide exposure to foreign markets. These can include ETFs focused on specific regions like Europe or Asia, or emerging markets with growth potential. Investing in international ETFs adds geographic diversification, which can protect you from downturns in the US market. Global diversification helps spread risk by not putting all your money into one country's economy. However, international ETFs come with additional risks, like currency fluctuations and political instability. Research is crucial before adding them to your portfolio. Sector ETFs focus on a specific industry, such as technology, healthcare, energy, or real estate. These funds allow investors to target sectors they believe will perform well, such as technology during a tech boom or healthcare during increased medical demand. Sector ETFs provide an opportunity to capitalize on market trends without picking individual stocks. However, they come with higher risk since they're not diversified across different sectors. It's a good idea to use sector ETFs to complement, not replace, a diversified portfolio. Leveraged ETFs aim to amplify the daily returns of an index, while inverse ETFs aim to profit when the index declines. These funds are complex and typically not recommended for beginners because they're designed for short-term trading rather than long-term investing. Leveraged and inverse ETFs can be tempting, but they're risky and can lead to significant losses if you're not careful. If you're just starting, it's best to stick with traditional ETFs and avoid these high-risk options until you're more experienced. ETFs are excellent tools for long-term wealth building, especially when you reinvest dividends and make regular contributions. By choosing a diversified ETF and holding it over the years, you can benefit from compound growth even through market ups and downs. The key to successful investing is consistency and patience. By investing in low-cost, diversified ETFs and holding on to them, you can take advantage of the power of compounding. which is crucial for growing wealth over time. And that's it. 15 essential things you need to know about ETFs for beginners. ETFs are a fantastic way to get started in investing, providing diversification, lower costs, and flexibility. If you found this video helpful, please like, subscribe, and share it with anyone who's interested in learning more about investing. Let us know in the comments if there's anything specific you'd like to know about ETFs or investing. Thanks for watching, and happy investing!